This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
Welcome back to TradeFlow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. It is Wednesday, July 15th, 2026, and the paper commodity exchanges have officially surrendered to physical reality. What started as institutional hoarding has now evolved into outright sovereign protectionism and regulatory halts. If your portfolio relies on cash-settled derivatives today, you are caught in the crossfire of a historic physical reset. Let's get you caught up for the global open. First up, the 60-second commodities flash. COMEX silver halted. The paper illusion is over. Following weeks of extreme divergence between the paper ticker and the OTC physical price, regulators have halted trading on front-month COMEX silver contracts. Rumors are swirling that clearinghouses are preparing to invoke force majeure, forcing cash settlement on delivery contracts because the vaults are functionally empty. OTC silver is completely unanchored, wildly quoting near $160.00 per ounce. Meanwhile, Brent clears $122. The energy baseline just moved again. Brent crude violently pushed past $122.40 a barrel in early European trading. The global heat waves are forcing emergency liquid fuel burns to keep sovereign power grids from collapsing, completely neutralizing the drop in consumer driving demand. Copper nationalization is live. Yesterday, governments blocked tech consortiums from buying copper mines. Today, they are taking the keys. Overnight, a major South American producer announced the immediate, temporary nationalization of a Tier 1 copper asset to ensure all refined output stays domestic. LME copper gapped up to $19,200 per ton. Finally, CPG giants suspend guidance. The digital rationing at supermarkets is destroying corporate visibility. Two massive global consumer packaged goods conglomerates completely suspended their Q3 and Q4 forward earnings guidance this morning, admitting that mathematical limits on consumer grocery purchases make it impossible to project future revenues. Let us take a deep dive into why the COMEX silver halt marks the death of paper price discovery and how copper nationalization permanently alters the global AI infrastructure timeline. The data hitting global terminals this Wednesday morning will be studied in macroeconomics classes for decades. We are watching the real-time transfer of power from financial exchanges to the entities that actually pull atoms out of the ground. Here is what is driving the midweek tape. Look at the silver force majeure event. We warned you this was coming. When OTC physical silver printed $150 while the COMEX paper price lingered near $105, a regulatory break was mathematically inevitable. When an exchange halts trading and invokes force majeure, it means they cannot honor the fundamental promise of the futures contract: physical delivery. Industrial buyers, solar manufacturers, and tech giants who were relying on those contracts are now being forcefully cashed out in fiat currency. But you cannot build a solar panel out of fiat currency. This regulatory halt has triggered a massive panic bid in the OTC market as procurement officers scramble to secure actual metal from private refiners at literally any price. This brings us to the sovereign copper grab. Yesterday's block of the AI hardware consortium's M&A deal was a warning shot. Today's outright nationalization of a Tier 1 mine is the main event. Sovereign nations have realized that exporting raw copper to foreign tech giants while their own domestic electrical grids fail is political suicide. By nationalizing the mine, the host country guarantees that the copper will be used to upgrade their own local infrastructure first. For the rest of the world, this means the free float of available copper just shrank massively overnight. Tech giants relying on imported copper for their Q4 data center pipelines are waking up to the reality that the metal they need is locked behind sovereign borders. At the same time, look closer at the digital rationing black market. The digital food rationing implemented by mega retailers earlier this week is generating bizarre unintended consequences. Because consumers are strictly limited on essential purchases like flour, cooking oil, and meat via their digital loyalty accounts, a secondary black market has formed overnight. We are seeing reports of people bartering or selling their excess loyalty quotas to large families on social media. Meanwhile, the CPG food giants are getting crushed on the stock market today because they can no longer rely on bulk buying consumers to drive volume. Agflation has effectively capped corporate food revenues. Here is the TradeFlow take. We have officially crossed the Rubicon. The COMEX silver halt and copper nationalizations prove that holding paper derivatives is a severe liability during a physical supercycle. Do not try to short or catch the falling knife in CPG or retail equities. Maintain maximum long exposure to domestic frontline energy producers. And hold physical tech metal assets, or the miners who pull them out of the ground with an absolute iron grip. The physical reset is here. Make sure to click subscribe and hit the notification bell at TradeFlow TV so your portfolio baseline stays synchronized with physical macro reality. Stay liquid, stay sharp. Have a highly defensive Wednesday session, and we will see you tomorrow.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.